at one point in your career, managed to uh, manage money at a shall we call it? Can we call it a family office? Is that
It
fair to
was a
call?
family office. Yeah,
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 yeah, yeah. I
um,
managed for the DuPont family for a number of years.
yeah. Is that when you start running those circles? I mean, everyone talks about, well, Warren Buffett says you can just buy and hold index funds. That's what he would do. And I always chuckle at that because I go, well, it's not what he does. He actually is quite active as an investor
Yeah, yeah. That's
and has outperformed, the index he proclaims is very tough
he
to
has a very
outperform.
concentrated portfolio. I mean,
And
he doesn't
yeah,
have that.
yeah. But how do these other, big families do it? What I see so often on social media is the conversation around, these big family offices or these big family names. They just load up on whole life insurance, and that's their strategy, and that's what they just do. And I just feel like that's so
I
so
see a lot.
inaccurate. Just curious
Uh,
if you care to share, is that world, are they more active in their investment approaches and philosophies in general, or do they just do a lot more, keep it simple, passive, buy and hold stuff for very long periods of time?
yeah, it's a really interesting question. I can just tell you, my perspective from working with the family that I worked with, um, who has had multi-generational wealth since the early 1800s. And what was interesting about that family is that they didn't really mess with bonds that much at all. Okay, they were in fact buy and hold investors with blue chip stocks that they held over the course of their lifetime. In many cases, they received a step up in cost basis on death, so nobody paid capital gains on those, and they were able to live off the dividends in many cases. But there's also been a real interest a little bit more recently in terms of looking at alternative investments. And that is, how do you make money on a regular basis, cash flow, gains, etc., without being tied into the financial markets at all, either the stock or the bond market, via real estate or private equity or or via startups, right?
Mm-hmm.
So that's become a little bit more the conversation for this last decade or two.
Yeah. Really interesting thing that's developed over the ZIRP era that we've lived through the last, since 2003, you might call it, right? So
Yeah,
last 20 years.
killed the bond market. Oh my gosh. I was looking at 5-year returns on, top rated bond funds. And it's like 2% per year over the last 5 years. That's not even keeping up with inflation.
I've almost felt like it's criminal to some of these institutions that would want to see, like their definition of balanced portfolio, you might say, or whatever, right? Or like, it is like the 60-40 portfolio, right? Like we want to see 40% bonds. And I was always like, that just
Hmm,
seems like a lot of, a lot of
maybe
people
that.
don't know about duration risk. A lot of other financial advisors I talk to don't even understand duration risk in a
Really?
portfolio, effective duration. There's actually there's a financial advisor. I won't say where they were at, but they had a client with it was like a just a standard bond fund. I'm trying to think if I can say this. It was just like a BlackRock bond fund, and these people were getting smoked in 2022, and bonds were getting hammered, and the advisor said, well, yeah, don't worry, you haven't lost any money, the bonds haven't matured yet, so it's fine. And it's like, that's not how, like, a
That's not
mutual
true. That's
it's like
not true
that's
at
not
all.
how
Because
that's
if you buy them at a premium, then you will definitely be on schedule to lose money by the time.
yeah, but it's that's like bonds, they're so like bonds are simple in concept, and then you start to look more at them and you realize that they're actually quite complex in the way that they start to actually trade. Right. Once you start trading a bond, it's a whole different game. Right. And the duration risk, or, effective duration, or for anyone that is listening and they want to go look up what I'm talking about later, you might have to look up Macaulay duration, but understanding the risk profile of a bond in that sense. And they didn't know what it was. And the egg was just creeping up. If you go and look back, it was like the effective duration of the egg, which is just, it's an index, but like doubled over the last 10 or 15 years. And the yield had just gone down. So you're not getting paid for the risk you're taking, and you're continually taking on more risk and more risk. And it reared its ugly head in 2022, right? And people got largely crushed in the bond market. And it's one thing if you get crushed in the equity market, because you were, you were likely getting rewarded for the risk, right? Or you at least had the capacity to get rewarded for that risk, right? If you're buying, say just into the index, a broad market index fund, it's like if the economy's going well and all this stuff, it has a good chance of going up, or maybe a better way to say it would be, you have a good chance at participating in any upward movement that might occur, right? But when you have zero interest rate policy on bonds, and it's like you can get whatever little tiny yield there is currently, but there's not really any upside, significant upside potential in the bonds. It's like the interest rates can't drop lower than zero in order for your bonds to become worth, to help the value of your bond increase.
Make your bonds worth doing.
Yeah. And so
I was just looking at my bond allocation, Brandon, and I have 6% allocation to bonds across my entire client portfolio right now.
Yeah. Well, and depending on where you're at in the bond space, now that interest rates are high, there's some really interesting places to be at in fixed income, right?
It's getting better.
Yeah. Senior bank loans is like a place that I think is a little interesting. I've had some really unique conversations around that. Short-term treasuries have been a great place for people to find, a reasonable yield with low risk, right? In fact, Jim Bianco, remember he was talking, he was the first one that, really talked to me about the idea or concept when he presented at that conference in October. And he said, like, interest rates are high enough that it's actually a tailwind that no one's talking about, because you just have these retirees that have all this cash that they'd normally had on the sidelines, and it was just doing nothing for them. And now all of a sudden, if you have $500,000 in cash or $1 million in cash, and, cash or cash equivalents, right? Play this game.
Yeah.
But all of a sudden you're a retired person, it's, and you were expecting it as part of your financial planning or whatever to produce $1,500 a year in interest income. And now it's producing $50,000 in interest income. You have a lot more money to go spend, right?
Yeah.
So it's an economic tailwind all of a sudden to have interest rates this high in
it is a boon for retirees specifically.
Yeah.
Because the Fed rate hike happened just in time to bail a lot of them out if they were in, cash CDs and short-term bonds.